SoFi, the fast growing digital banking platform, has had an incredible 2024, up more than 50% for the year. And after trading sideways for what seemed like an eternity, the stock finally broke past the $10 price level and is now trading at about $15 a share. The rally was really strong and we saw the stock go up as high as $18 a share, but however, the Bulls lost their momentum when SoFi reported its Q4 and full year 2024 results, sending the stock crashing down more than 10% in a single day and is now trading roughly 20% off its recent highs. So, in today's video, I want to talk about SoFi's Q4 earnings results, why the stock is selling off, and why I think SoFi stock is still a great buy today. As always, you can read the article version of this analysis, which I will leave the link in the description box below. And with that being said, let's take a look at SoFi's Q4 results. So first things first, Q4 revenue came in at $734 million, up 19% year over year, which beat analyst estimates by $52 million, which is a huge margin. Similarly, adjusted revenue was $739 million, up 24% year over year, which also beat the high end of management's guidance by $56 million. So, right away, a really strong result in terms of growth, which is a strong testament to management's execution and SoFi's incredible value proposition as a one stop shop for all things finance. So, strong revenue growth was driven by strong member growth, which was 10.1 million as of Q4, up 34% year over year, and adding a record high of 785,000 new members in a single quarter. So, this is the first time that members surpassed the 10 million mark, which I think is an important milestone and a confirmation of the fact that SoFi is the future of banking. So, with higher member count, product adoption naturally increased as well, which was 14.7 million as of Q4, up 32% year over year, and adding a record high of 1.1 million new products in a single quarter. Also, notice that SoFi has added more new products than new members, which means more and more members are using multiple SoFi products. And this is a good thing because it will drive higher engagement, higher loyalty, and higher revenue per member. But it's important to note that multi product adoption is still very low. So if we take total products and divided it by total members, we got product per member of 1.46. So this means that on average, members on the SoFi platform uses only 1.46 of SoFi's products. And considering that SoFi offers 9 different major products, I think there's still so much runway ahead in terms of cross selling their products and extracting as much value from each member. So, maintaining strong member growth while maximizing product adoption will be key for SoFi, which should drive exponential growth for years to come. So, if we look at revenue by segment, we can see that all three segments delivered record revenues in Q4. So, first, the lending segment reported $423 million of adjusted revenue in the quarter, up 22% year over year. And as you can see, this is the third consecutive quarter where growth has accelerated. So, this was driven by record total loan volumes of $7.2 billion, which grew 66% year over year, propelled by strong demand for personal loans, student loans, and home loans, where volumes grew by 63%, 71%, and 87% respectively. And as management noted, the fourth quarter of 2024 represented their best quarter of capital markets transaction since going public. So overall, very strong momentum in the lending segment, and with more rate cuts expected this year, I think growth for the lending segment will continue to remain robust throughout the year. On a less positive note, the tech platform segment has been struggling as of lately. The segment generated $103 million of revenue in Q4, which is up only 6% year over year. And this was driven by a 15% increase in tech platform accounts, which is now about 168 million in total. But keep in mind that growth for the segment has always been lumpy due to deal timing and lengthy program launches. And while the tech platform landed some major deals in Q4, like the US Department of the Treasury, we won't see the impact of these deals until 2026. So growth may be muted in the foreseeable future. The good thing is that the tech platform is the smallest and least profitable segment of the three, so I think it's not a big problem for investors. And last but not least, we have the financial services segment, which delivered $257 million of revenue in the quarter, up 84% year over year. And this was driven by increased consumer deposits, increased product adoption, as well as the rapid growth of the loan platform business, which generated $63 million of loan platform fees in Q4, up from $56 million in Q3. So, with new products like the new Robo Advisor platform in partnership with BlackRock, as well as the $525 million securitization agreement with PGIM, I believe the financial services segment will maintain its robust growth profile in 2025. So, all in all, it was a very strong quarter in terms of growth. And the best thing is that management continues to expect strong growth in 2025. So much so that they have issued revenue guidance that are well above analyst estimates. So for the full year of 2025, they expect adjusted net revenue of $3.275 billion at the high end, implying a 26% year over year growth rate, which beat analyst estimates of $3.05 billion. And for Q1, they expect adjusted net revenue of $745 million at the high end, which beat estimates of $708 million. And this implies a growth rate of 28%, which also means that growth is set to accelerate from Q4's growth of 24%. So as you can see, this is very strong revenue guidance, but despite this very strong guidance, I think management is still sandbagging their guidance. For one, baked into their guidance is the underlying assumption that there will be 1.5 rate cuts this year. And keep in mind that back in December last year, the Fed has planned to cut rates twice in 2025. So if we see at least two rate cuts this year, I think SoFi will drive even stronger growth than what management guided. In addition, management has a serious history of sandbagging guidance. For example, at the start of 2024, they guided for 14% to 16% adjusted net revenue growth in 2024. Well, that was a really low estimate because SoFi ended up delivering 26% year over year growth in 2024, which is a full 10 percentage points higher than the high end of their guidance. So, with that being said, considering their conservative assumptions and their history of sandbagging guidance, I think a 30% year over year growth rate in 2025 is more than likely as compared to just 23% to 26% year over year growth that they guided. And because of this stronger growth, we can expect higher earnings growth ahead. Speaking of which, SoFi continues to drive strong profitability in Q4. So here we can see contribution profit on an aggregate basis and a segmented basis. As you can see, SoFi drove a record high of $393 million of contribution profit in Q4, representing a 53% contribution margin, which expanded by 6 percentage points year over year. So SoFi continues to drive strong operating leverage. And looking at each segment, the lending segment drove $246 million of contribution profit in Q4, which represented a 58% contribution margin. And take notice that this is actually a decline of 7 percentage points year over year from 65% in Q4 last year to just 58% this year. So this was mainly due to a 20% year over year decline in non-interest income, as well as a 47% increase in direct expenses, likely as a result of higher marketing activity since management is now seeing a healthier and more favorable capital market. Turning over to the tech platform, we can see that contribution profit for the segment was $32 million in Q4, representing a margin of 31%, which has been pretty much flat over the past few quarters, both on an absolute basis as well as on a marginal basis. So there's nothing really interesting to discuss right here. On the other hand, the financial services segment continues to enjoy economies of scale, delivering $115 million of contribution profit in Q4, with margins expanding 27 percentage points year over year from 18% to 45%. So, with this kind of momentum, I wouldn't be surprised if margins reach at least 50% this year and eventually expanding to about 60% in the long run. Moving on, adjusted EBITDA was a record $198 million in Q4 at a 27% margin. And this beat analyst estimates by $18 million, so that's really good to see. So margins did drop 3 percentage points year over year from 30% to 27%, and this was mainly due to an acceleration in sales and marketing expenses, which grew 31% year over year as the company reinvests in the business to continue to drive profitable growth well into the future. In terms of the bottom line, net income was $332 million in Q4, which included a one-time income tax benefit of about $271 million. So excluding this benefit, adjusted net income was $61 million at an 8% adjusted net margin, which was about flat year over year. On a per share basis, earnings per share was 5 cents, which beat analyst expectations by 1 cent. So all in all, I think SoFi continues to demonstrate solid profitability and operating leverage, which should support earnings growth for years to come. However, expect profitability to dip slightly in Q1 as management ramped up spending to drive growth. So in Q1, management guided for adjusted EBITDA of about $185 million at the high end, implying an adjusted EBITDA margin of 25%, which is down 2 percentage points quarter over quarter. Net income in Q1 is expected to be $40 million, which implies a 5% net margin, and this is also down 3 percentage points quarter over quarter. And finally, Q1 EPS is expected to be about 3 cents, which is down 2 cents quarter over quarter. The good news is that as SoFi progresses through the year, we can expect profitability to improve gradually. So for the full year, management expects adjusted EBITDA of $865 million at the high end, implying a 26% margin, which is up about 1 percentage points year over year. 2025 net income is expected to be $305 million at the high end, implying a 9% net margin, which is also up about 1 percentage points year over year. And finally, 2025 EPS is expected to be 27 cents at the high end, up from just 15 cents in 2024. But keep in mind that SoFi's Q1 and full year 2025 adjusted EBITDA, net income, and diluted EPS guidance, they all miss analyst estimates, which is probably the sole reason why the stock sold off in the first place. With that in mind, I think the market is overreacting here because, as I've mentioned earlier, management has a history of sandbagging guidance. So if we look at this slide again, we can see that at the beginning of 2024, management originally guided for $105 million of adjusted net income and 8 cents of adjusted EPS at the high end. But if we look at their actual 2024 results, we can see that SoFi has completely destroyed their initial guidance with $227 million of adjusted net income and 15 cents of adjusted diluted EPS, which is more or less double than their original guidance. So if it's not clear enough for you, management has the tendency to underpromise and overdeliver, and they have actually provided this slide to tell us investors like, hey, we actually sandbagged our guidance by a huge margin, and you guys better believe that we're going to do the same thing this year. So whatever guidance management gave us recently, I think they intentionally set them at a very low level and I think SoFi will comfortably beat their own guidance. Interestingly, if we look at analyst estimates, which is the table above right here, we can see that analysts now expect an EPS of 25 cents in 2025 and then an EPS of 50 cents in 2026. So, as a reminder, management guided for 2025 EPS of 25 cents to 27 cents and 2026 EPS of 55 cents to 80 cents, which means analysts now expect SoFi to achieve EPS that are at or below management's guidance, which I think is just way too negative. Firstly, management remains confident in delivering their 2026 EPS target of 55 cents to 80 cents. So I'm not sure why analysts project a lower EPS than what is guided. And secondly, SoFi has beaten all but one quarterly EPS estimate ever since going public. So they have a near perfect track record of beating estimates. You can ignore the huge miss in Q3 of 2023 because there was a one-time goodwill impairment charge. So without this charge, EPS would have been negative 3 cents, which beat estimates of negative 8 cents. So in short, I think management is just too conservative on their guidance and analysts are just too negative on their estimates. And this combination is going to set a very low bar for SoFi to outperform expectations. And when SoFi beat expectations, which they always does, I think we're going to see a major move to the upside. Moving on, SoFi continues to expand its balance sheet. Total loans as of Q4 was $27.5 billion, which is up $0.9 billion quarter over quarter. Total deposits was $26 billion, up $1.6 billion quarter over quarter, and total debt was $3.1 billion, down $0.1 billion quarter over quarter. So it's good to see that deposits grew substantially compared to debt, which means that all the loan growth that we see right here on its balance sheet was pretty much funded by customer deposits, which is much more cost efficient than using debt. To put that into perspective, according to management in Q4, the average rate on deposits was 193 basis points lower than debt, allowing SoFi to save approximately $500 million in annual interest expense, which should help with overall profitability. Tangible book value was $4.9 billion as of Q4, growing $0.5 billion quarter over quarter, as you can see right here. And management is guiding for TBV growth of about $575 million at the high end in 2025, which again I think is just very low. Again, I think this is a sandbagged figure because management originally guided for $300 million to $500 million in TBV growth in 2024, but ended up growing TBV by $1.4 billion last year. So similar to every other metric, I think TBV growth in 2025 will be much higher than management's guidance of just $575 million. SoFi's credit performance continues to improve as well. As you can see, at 45% remaining unpaid principal, net cumulative losses or NCL is 3.81% for its recent loan vintages from Q4 2022 to Q1 2024, which is the purple line right here. And this compares favorably to its older 2017 loan vintage, which is the gray line right here, which recorded an NCL of 5.25% at the same 45% remaining unpaid principal. In other words, at 45% remaining unpaid balance, there is a 144 basis points improvement in credit performance. So if you take 5.25% minus 3.81%, we get 144 basis points. So that is the improvement between the new cohort and the 2017 cohort. So that's really good to see. In addition, of the $44 billion of Q1 2020 to Q3 2024 loans originated, only 42% remains unpaid. And of the 58% that has already been paid down, SoFi incurred an NCL of 6.5%, which is well below management's 8% maximum NCL target. So for the entire cohort to reach 8% NCL, the remaining 42% unpaid principal would need to experience an NCL of more than 10%, which is very, very unlikely. So in short, I think SoFi's balance sheet and loan portfolio is in a very strong financial footing. Now, looking at valuation, SoFi used to trade at a discount to industry leader JP Morgan, but after its, recent 150% rally since August last year, SoFi is now trading at a premium to legacy banks. So as you can see, SoFi now trades at a price to tangible book ratio of about 3.61 times, which is a premium to JP Morgan's multiple of 2.9 times and Bank of America's multiple of 1.8 times. And I think this premium is justified given SoFi's growth and earnings potential. As for me, I'm raising my price target on SoFi stock from $16 a share to about $20 a share for my base case. So you can see my key assumptions and you can also see my bear and bull cases. So if you need more time to look at them, feel free to pause the video. That being said, my base case price target of $20 a share represents an upside potential of about 35% based on the current share price of about $15 a share. Considering the recent rally, I think this is a very decent return profile in 2025. However, this is based on very conservative assumptions that management guided for, which, as you can probably tell, is way too conservative. And as we've seen in the past few years and quarters, SoFi has consistently smashed growth and earnings expectations, and considering management's overly conservative guidance, I think they will again outperform expectations this year, which leads me to believe that my bull case seems to be the more likely outcome. So if SoFi executes well this year, I think it might have a chance of hitting $25 a share in 2025, which represents an upside potential of 71%. So wrapping this video up, I think the SoFi investment thesis remains well intact. The company continues to disrupt traditional banking, attracting more members than ever and driving higher product adoption than ever before. Its lending segment is reaccelerating, its financial services segment is still in hypergrowth mode, and we're also seeing stable growth in the tech platform business. While management guided for strong revenue growth that was well above expectations, its adjusted EBITDA and EPS guide was a little too soft. As I see it, I think SoFi is just sacrificing short-term profits to fuel long-term, durable, profitable growth, which in my opinion is the right strategy in 2025, given that the company is now profitable with a strong balance sheet to support its growth. But unfortunately, the market did not like SoFi's mixed guidance, which led to the stock selling off by 20% since its recent highs. However, it's important to note that management tends to sandbag their guidance, and now that analysts have lowered their expectations as well, I believe this sets SoFi nicely to smash all expectations throughout the year, which should spark a major move to the upside. With that being said, thank you so much for watching this video, and if you enjoyed this video, please leave a like and comment and subscribe to my channel for more investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys in the next video.